Good day to you and welcome to another Paddocks Club video tutorial. Today we're going to talk about theft and fraud in community schemes. Not a particularly happy subject, but an important one. First, let's define the terms. Theft is the unauthorized taking, often referred to as misappropriation of scheme assets, whether in the form of money or movable assets. Fraud, on the other hand, is the secretive taking of money or any other material benefit at the expense of the scheme, and to which the person is not actually entitled. The background to these concepts, I suppose, is that it can be uncomfortable to consider the possibility that others you work with, your neighbors, those you employ, might steal from you or your scheme, or defraud you and your neighbors. But the harsh reality is that theft and fraud are regular, recurring problems in all community schemes, not only in South Africa, but internationally. One of the main reasons, you may know, that the government introduced the concept of sectional title was because there were problems in shared block schemes, which were the forerunners. And so they created an alternative legal system which would protect shareholders from the risk of loss of their homes. This being a direct result of the problem which has continued to recur in South African society. How does this present? Well, the most common and most easily detected form of theft from schemes is when an individual executive, trustee, director, whatever it is, or managing agent makes unauthorized withdrawals from the scheme's accumulated reserves. But that's not the only way it can happen. There are more subtle, less easily detected methods. The intentional overpayment of an employee or service provider and the making of apparently authorized payments to a dummy account controlled by the thief are simple examples, unfortunately reasonably common. A very obvious example of fraud by a chairperson and a contractor is when, in the process of supervising and carrying out a contract for works on the common or communal property, they arrange that additional work will be done on the chairperson's individual property at no cost to the chairperson. A more subtle fraud is, for example, when a managing agent whose contract has been arranged by the developer persuades the scheme executive to spend money on fixing part of the common property or communal property, while the managing agent knows or suspects that the individual owners have the right to demand that the developer fix the problem. Any undisclosed arrangement that an executive or a managing agent makes with a service provider, in terms of which the service provider pays over a share of the amount paid by the scheme, is fraudulent, or any benefit that that person gets, it similarly is fraudulent. Any secret arrangement in terms of which the service provider gives any substantial benefit to the scheme executives or managing agent is simply illegal. The executives, the directors or trustees, have a common law duty, in addition to any relevant provisions in any act that might apply, to ensure that the scheme's assets are preserved and to take all reasonable steps to avoid and detect theft and fraud. It is vitally important. This is a vital part of what the executive is supposed to do. So let's look at it in practice. Well, you must ensure that tenders are competitive. When the scheme places any substantial contracts, for example, the installation of a new security system, the work should be put out to tender, and the tender process should be controlled by the scheme executives, not by the managing agent. You may use the managing agent to run the process, but in the end the decisions must be made by the trustees or the directors. The executives should ensure that the majority of the businesses who tender are independent of the developer, the managing agent, and of any of the executives. This is very important. There is also an issue which is all too easily ignored. The monthly management reports, if you do any international research, you will find into this problem, which is, as I say, completely international. You will see that the one thing people tell you again and again can cure this, the way to stop it, is to interrogate the monthly management reports really, really carefully. The monthly financial management report with accrued income and expenses for the year to date, vouchers and bank statements, that's the most important tool for the executives to check the financial health of the scheme. If the executives don't properly interrogate the monthly management reports, and everyone knows that this is the case, then well, if they don't, it's more likely fraud will happen. But everybody knows that they do it, then it's very much more likely that fraud will not happen. That people won't, because they'll realize that this thing will be detected almost immediately. In addition to obtaining an overall understanding of the management report, the executives should also look at some particular documents. They must inspect the payroll listing, have a look at it, compare it to previous ones. They should inspect the bank statements and vouchers. Don't leave that up to other people. Have a good look at that yourself and check the bank reconciliation statement. If you do that, the chances of there being any funny business behind those statements is very substantially reduced. Then let's look at kickbacks. A range of kickbacks, sometimes obvious but usually much more subtle, have been a feature of the community management, scheme management industry for many, many years. They're sometimes explained as standard industry practice. The excuse may be that the recipient did in fact form some sort of valuable service which the service provider was keen to reward. That's all complete poppycock. Normally the proof of intent to hide the payment is found in the fact that the scheme's books of account don't show any evidence of the payment. The simple fact is that if any of the HOA or scheme's money has been paid to an intermediary or a facilitator without the informed consent of the HOA or the scheme executives, the trustees, that constitutes a criminal act. Any such payment must be properly authorized and reflected in the HOA or scheme's accounting records. Finally, let's look at the auditor's rule. At the role in prevention. You mustn't assume that the auditor is checking for theft or fraud. The normal conventional audit is not designed to find theft or fraud. It's designed to state whether financial statements are a fair reflection of the accounting records and are apparently in accordance with all applicable laws as seen within some particular accounting framework. If the accounting records have been carefully kept so as to conceal fraud, it's highly unlikely that the auditor will have any reason to become suspicious. Where an HOA or a scheme depends on a managing agent to do the regular bookkeeping, it is important that the executives hire a separate auditor. That way the person checking the accounting records will report directly to the HOA or the scheme and provide a proper counterbalance to an employee accountant whose duties are only to the managing agent. I hope that this has been of assistance to you, and I hope that you don't actually have to deal with any of these problems in practice. But thank you for watching this Paddocks Club video tutorial.